You are listening to Keystone's Stock Talk Show, episode 184.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
Great to be with you this week. I'm back from an analyst conference in LA, and we are on the precipice of our fall webinars on Wednesday and in person, our VIP seminars this weekend in Vancouver and Calgary. We kick off the special show with a brief discussion on legendary US stock jock Jim Cramer's mea culpa on his buy recommendation on Meta or Facebook, which has not worked out so well. This week, we initiate a new feature interviewing top management teams of solid Canadian and US growth and dividend growth stocks. We expect to interview one per month moving forward. This month, we welcome Renee Gorham, President and CEO of TSX Venture-listed BioSyent Inc., symbol RX on the TSX Venture. It's a profitable, growth-oriented specialty pharma company focused on in-licensing or acquiring innovative pharmaceutical and other healthcare products, primarily in the Canadian market. The interview is quite extensive, and we hope you enjoy the format. Our star of the week is Hammond Power Solutions, Inc., symbol HPS.A on the TSX, which should be no stranger to clients, having been a focus buy in our Canadian small-cap growth stock coverage for a number of years. The company itself enables electrification, I can't speak English, through its broad range type transformers, power quality products, and related magnetics. Hammond serves the oil and gas, mining, steel, wastewater treatment, commercial construction, data centers, EV charging, energy storage, solar, and wind power generation industries. The stock jumped 20% this week, or just in the past 2 days, and is up 67% in 2022. Powered by record results throughout the year, particularly those strong Q3 results just announced at the end of last week. I'm going to welcome my co-hosts, Aaron and the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well. Salutations.
Good to hear.
You guys
Brennan's
like my
dressed
costume?
like a leprechaun today.
I guess Ryan and I are getting ready to take the kids out trick-or-treating, and Brett and Brennan
going
are
out trick-or-treating.
getting their costumes ready to go.
It's true. Yes.
Nah, you guys, I'm sure you have some wild young man parties tonight.
No.
Young old
This is
man
actually,
parties.
I was telling
That's
Ryan,
what
this is the first.
These guys will be reading financial reports
exactly,
tonight.
working on slides.
Preferring
for
that.
the presentations coming up.
Yeah, we do. We have a lot of content that we're putting together.
It's true.
That's right. So, upcoming this week is I believe it's on Wednesday, is our first DIY seminar, the webinar. It's the online version of the DIY, but coming up on the weekend, the first time in years, we're going to be doing in-person VIP DIY events. And that's going to be in Vancouver on Saturday and Calgary on Sunday. So that's really exciting.
I mean, usually we'd be hammering away at getting people to get tickets to those, but literally those two VIPs are basically sold out. I mean, I think there's a couple tickets left. Mm-hmm. And the tickets are going incredibly well for the webinars next week. Yeah, if you want tickets, it's what is it? The 2nd, November 2nd, this Wednesday, and November 8th. Is that next Tuesday? Yeah. Right? Yes. Okay. So, and November, it's 7:00 Pacific this Wednesday, and then it's 7:00 Eastern next Tuesday. So if you want tickets to those, grab those because they're going very fast. And we're just going to tell you how to build that simple 15 to 20 stock portfolio. There's 7 buy recommendations in there as well. Aaron, sorry I cut you off. You were talking, I think.
No, you're probably just completing my sentence.
Good.
So thank you.
That's like always. We're like twins, right? Like everybody says that when they see us.
Well, we actually have identical vehicles.
I know, it's awesome.
So
Aaron's big joke is twins all the time.
So
twins.
yeah. Yeah.
Because
guys
everybody
look pretty
says that
too.
about us. It's so weird.
People can't
It's
tell us
true.
apart.
It's true. Just like Brett and Brennan, they can't tell them apart. Too,
Yeah.
right? It's true.
Spitting
You guys are
image.
brothers.
That's why he wears the hat.
Except for the hat.
Yeah.
Except for the hat. Yeah.
Thank God. And the hat and glasses.
Why don't you explain the hat?
Yeah,
just
well,
really
just
quickly?
the whole
Yeah.
suit. This was actually my grandpa's suit. He was one of the original 8 founding members who brought the Prince Albert Raiders from the SJHL to the WHL in Prince Albert. So he actually passed away in 2015. And I didn't think that I'd ever really wear his suit on an occasion, but today is that occasion. So I am wearing it in his honor for Halloween. I hope
That's
that he's
awesome.
okay with that.
Yeah. It is
but
awesome.
yes,
I'm sure
there's
he would be.
The Prince Albert Raiders logo, and then also right there as well.
Yes, it's beautiful. You should wear that.
That's actually an awesome story. It's my intention was actually to use the story to somehow
Now you
make
can't.
fun of Brennan, but that's actually a really good story. And then full respect for your to your grandpa for being a part of Canadian hockey.
And he was actually like one of the longest.
Now I have to be nice to Brennan. Also, now I have
he was one of the longest season holder tickets, so he had one basically his whole life. And my parents were actually going to bring this to Value Village or Salvation Army, and I was like, "There's not a chance. Like, you guys have to."
Yeah,
I probably won't wear it, but
and it fits you.
It smells like my grandparents' house.
Nice.
Yeah, I don't even think I'll get it dry cleaned.
I know that's
some memories, right?
Yeah,
my house is starting to smell that way. That's
great.
the sad part. Right? God, it's
just every room the client's in.
The same.
The rest of the house is fine.
No. I think you said season holder ticket. What's a season holder ticket? You mean season ticket holder?
Season ticket holder. Yes.
That's
some
good.
days I just
I got that.
Your story was too good. I'm not going to make fun of you, so it's good.
Yeah.
Well, you just did.
No, that's good.
Well, I was just clarifying for the listeners, right? What they're like, what's this?
Not as much as he would have.
Yes, I would have ripped into you. That was just a slight bit. Okay.
Yeah.
Yeah.
Just wait until I'm in front of the crowd this weekend. It's going to be interesting what comes out of my mouth.
Yeah. Wearing your
you got to wear one of those to one of our analyst meetings and say and eat some Lucky Charms at the same time and see what you think.
Yeah, that'd be good.
Oh, that would be great. All right, so let's get to our first bit of news this week. I think Jim Cramer, legendary kind of stock jock in the U.S., came out, made a mea culpa here, said, I made a mistake. I was wrong. I trusted management team, not myself. I was wrong. So should we play the clip?
I made a mistake here. I was wrong. I trusted this management team. That was ill-advised. Hubris here is extraordinary. And I apologize.
Okay. What did you get wrong?
I had a belief that there was a recognition that there is a amount that you can't spend. Contrast that, for instance, with Jim Farley, who took a project that was his, Argo, and closed it because it was not ready. It was not near enough. This situation is almost a rogue situation. I had thought there would be an understanding that you just can't spend and spend right through your free cash flow. That there had to be some level of discipline, and I didn't get it. But David, what did I get wrong? I trusted them, not myself. For that, I regret. Okay. I've been in this business for 40 years, and I did a bad job.
He played that, did a mea culpa, and he teared up and said he was wrong about it, and his recommendation on Facebook was wrong, and he felt terrible on it. But I mean, I would say, like, as far as I understand, like the management team at Facebook stated that, you know, it was a 10-year venture, a 10+ year venture, and the company had a weaker than expected quarter without a doubt, but it has been trending like financially downwards for several quarters. So if his thesis was based on anything that we were going to see in that quarter, yes, it was probably worse than most of the market and he expected. Really, if it was just based on that, then his analysis was negligent. And to me, any buy thesis, if you had a buy thesis on Meta it would have been a belief in the long-term investment in the metaverse, because this is what they telegraphed that they were going to do. So, which would suggest some near-term pain. So, changing your opinion now, now saying I was wrong and we shouldn't buy, it just looks like he did some very, very cursory analysis going in. And it really, to me, it looks bad shedding a tear. It looks like crocodile tears. And like, I'm trying to distract away from my pathetic analysis, to be honest. Just, I would rather have him say I was wrong. I don't think we need the tears there. And, they asked him, what were you wrong on? And he said, I trusted management. Well, and not myself. Well, I mean, you got to trust your analysis, right? And that's, management is part of that. But your full analysis can't be, I like management, I bought stock. That can't be the full analysis. Seems really like pathetic and cursory analysis to me. I don't know. You guys' thoughts?
Yeah, like he called it a rogue situation, in relation to the company not having any discipline to capital. Like they're investing heavily right now. But I mean, realistically, they're making
we came.
A new
let's
category.
Just put it out there too. We came out and said, like,
Last
we
week,
did our analysis on this company, and we wouldn't be buying because of what was upcoming, and because we saw the metaverse is a huge risk. Like, I'm not sure how you didn't come to that inclusion versus the buy, which is what Cramer.
And especially when management's saying it's a 10-year timeline, like this, we're investing now for the future. Like this might not bear fruit for a while. And it is really.
So we're surprised when they have a weak quarter. That seems silly.
Yeah. And that they have to invest heavily to essentially make this new category. I mean, I would kind of say that it's a new category, kind of, really, to get people to adopt into the metaverse. And, maybe in 10 years, it will be, commonplace. But yeah, I mean, in the near term, I don't see what Cramer was seeing.
Well, it wasn't just Cramer. The entire stock dropped 25%.
Yeah.
It's not just an isolated instance of one television analyst.
He was the only one. Yeah. Everybody else was saying sell, and everybody held on for him, and then he lost everything.
It was just him. It was just him. That's what we're saying. And it wasn't like the stock hadn't already been dropped. It's down 70% since its highs of. Yeah. This shouldn't have been a shock to anyone. I don't know how a single person who looked into the company more than 30 seconds is shocked to where it's a 25% drop on this earnings.
Yeah.
There shouldn't have been that bit. Like, sure, a drop. But 25% on a mega cap like this is just ridiculous.
Yeah. Yeah. And it's but like we said, the fundamentals were deteriorating. So it was going in this direction. And you looked at other social media stocks, what they were posting, weaker results, getting hit. Yeah. The surprise to me is the surprise. Like, being surprised that the results came in weaker is a surprise. Like, if somebody was surprised, you know what I'm saying?
I know what you're saying.
This was a pandemic boom story as well, right? I mean, it's one of the stories they did very well during the pandemic. Now we're out of the pandemic, so they're as like a lot of other companies out there that did well during the pandemic, they have to give some of those earnings back. Now we're seeing results come down. There could be other things in play at Facebook as well. I mean, there's been some
moves at Apple,
the
right?
iPhone, like the
privacy. Apple privacy.
Yeah, I mean, there's a lot of things going on there, but I mean, in terms of, I mean, I don't know what Cramer was really talking about. There's no need to cry, right? I mean, you as an analyst, you do the best job you can to provide an analysis on a company, and if you're wrong on some areas and you find out where you're wrong and you own it, which he said, I'm owning it, but I'm not really sure where the tears come into play. I mean, a grown adult crying over something like, the financial markets is, it's just really disingenuous to me. And I don't really like to see it. Just focus on the facts. And, I also don't know what he meant, just like what you said, Ron, about, I trust
they asked him.
Well, I'm not sure what did management say that made you think that this was
he trusted maybe they'd be better stewards of capital, but I mean, they had come out and said it was going to be a long-term investment. We're going to spend a lot of money.
And my understanding, sorry, Brett, do you know what my understanding is, that they've invested about a billion into the metaverse?
10 billion.
How much? 10 billion. Okay. So it's $10 billion. Yeah. So that's a very significant investment. Now, to put that into perspective, that's about, like their current market cap, even after all the declines that they've seen. I mean, they've lost about 3/4 of their share price almost in, a little over a year. The current market cap is in the range of like 250 billion. So yeah, that's a lot of money. But that in and of itself would not explain a 25% drop in the share price. The drop in the share price was more just about continued weakness in the financial results. Yeah, there's a lot of negative press on the whole Meta thing, but I mean, it's only been about a year since they changed their name and have really pursued this path. I wouldn't expect, there to be a big change within a year. I mean, this is, you look at other companies that engage in big, like just to take Walt Disney, for example, Disney with their Disney Plus, right? They said straight up, it's going to be 5-6 years before it's profitable. And that's more along the timelines that I would expect for something like the metaverse. Now, I don't own Meta shares. I never recommended them. I don't know anything about the metaverse. So I'm not the best person to talk about it, but I wouldn't expect that it's going to be an overnight thing. I would be more concerned just about the current state of the company's business and ad sales.
Yeah, I think the biggest problem I have with the entire mea culpa there is they give him a chance to say, he said, I got it wrong. That's fine. Then given a chance to explain to viewers what you got wrong, you kind of choke out, I trusted management too much. I mean, if your entire thesis is just, I like management, and I already said this, like, it's not analysis into a company. I'm sorry, you're not doing analysis. So you shouldn't be too choked up. You should be choked up or mad at yourself because that's all you did, basically, if that's your entire analysis. So, I mean, that would be what I would look at it, because like Brett said, anybody who did 30 seconds of analysis could see it was trending negatively in the near term. Like, your only thesis would have been a belief long-term in management, and then you were completely... your thesis completely would have had to change at that point because of a poor quarter. Well, it just seems like fly by the seat of your pants analysis. That's all I'm trying to say, really. And I think that's what I'll...
Yeah, one thing I am going to say is that there is a huge amount of risk in what Facebook is doing. And this is something that every investor should understand. When you're basically looking at your company and you're saying, 5 to 10 years, our current business...
So hard to predict.
Relevant in the market. So we have to completely transform what we're doing. It's almost like you're becoming a startup again. Like if you look at like what Face or Meta owns now outside of Facebook, there's Instagram, there's WhatsApp, a few other things, but they never developed those technologies. They acquired them. That's why a lot of companies, when they get the Facebook size, prefer the route of acquisition, because developing a whole new business, it's almost like you become a startup again. And
the risks
is there's a lot of research on it. Like startups that have a lot of money, having a lot of money can actually be a detriment, because you can pursue bad ideas indefinitely, or until, that huge war chest runs out. And so I personally, like when I look at Facebook or Meta and like what they're doing, I'd be very cautious about, whether they have the ability, even with all of their financial resources, to really be the leaders of the metaverse, or if the future leader of the metaverse in 5 to 10 years is going to be some startup that nobody even knows about right now. That would be more my concern on a company like that.
I will say they are using Oculus, which they acquired like 2014 or something like that. I'll put up the date. And that's going to be a lot of their R&D right now. Like they just released a new VR headset for about $1,500, which is on the higher end.
US.
So they are trying to get some sort of, US, which before that you're looking at probably about $1,000 at most for even higher end ones.
Yeah.
Besides, for consumer grade, I should say, there are extremely expensive VR headsets. And so they are trying to get something in there. So if they can kind of slow the bleeding, and then a decade out, they have like that big pop-off moment where it just shoots up that parabolic run in revenue, then sure, there's something, but there's just so much risk.
Yeah. I mean, and that's what we hashed out.
Once again, I'm not a
Sorry.
Yeah. I'm not a metaverse guy. I'm not a gamer guy, but I have to say that is as attractive as the potential of VR is. I don't think it's really.
No, it's not. It's niche
right
now.
No,
not even close.
Yeah, it's. But I mean, I remember even when I was a teenager, there was VR, and I tried it, and I thought within a few years it was going to really catch on and dominate gaming.
In the Stone Age, there was.
decades. I know. Now we're hundreds of years later.
Yeah. Anyways,
many decades later, and they're still talking. So I still think it's going to happen, but who knows when. I think that what Meta is trying to do is they're trying to invest ahead so that when, it really does explode, they're basically there with all the infrastructure. Are they going to develop the apps or the app or the system, the platform that the kids at that time want to use? Who knows?
And, we're not, when we hashed out, like we looked at Meta and it screened fairly well in our screeners.
Mm-hmm.
I mean, it's a cash rich business that they have 2.5 billion users. Like it's crazy how many users they have. Good cash flow they had right up until the last quarter, essentially. So like we hash out, do we like this business? Because it starts to look right now quite cheap. If you look historically at the cash flow it's generated and the price it's trading at now. But they made a visionary bet that we just have no insight into. So we cannot, we know the risks are high, and we're just not comfortable making that bet with our money when we can see other platforms out there, within the FANG universe, if you want to even just look there, that have far more certainty and far less risk and trade at also reasonable prices. So you're looking at the company, you're looking at the risk relative to other businesses that are similar to some degree. And, our determination was, they're making a visionary call going forward, and you have to believe in that. We have no special insight into whether maybe the metaverse works and maybe it's not Facebook that even is behind it, to be honest. That can happen. But if it works and everything hits for them, maybe it works well 5 to 10 years from now, or it could completely flop. And then you have your downside risk, and the company's invested tens of billions of dollars in this, right? So, at that point, it didn't make any sense for us. It still doesn't make any sense for us right now. So we're glad to have avoided that. There's some other names that we like at this point. Now, we had some other topics we're going to go on. Let's just look at the Canadians, this headline, Canadians have never felt worse about their finances. Then we'll cut it. We'll do our star, and we've got a big interview this week that everybody would like to get to. So this headline is is a little bit more than it is. It says Canadians have never felt worse about their finances. It's a poll. But then, of course, you look into it and says they say their finances haven't been this bad in more than a decade. So, I mean, if never is just 10 years now, I guess. But, I mean, and, it goes into it. Brett or Brennan, do you want to look at this a little bit, or have you guys looked at it
I can
further? It's a Nanos poll, right?
Exactly. So every week, Nanos Research surveys 250 Canadians for their views on personal finances, job security, the economy, and real estate prices. And essentially, the highlights from the latest data were that, let me see here, Canadians are extremely pessimistic about the outlook for the economy, with 64% saying they expect it to deteriorate over the next 6 months, and only 9% seeing an improvement. There's also sentiment around real estate has been sliding since March, which, doesn't come as a surprise. When interest rates began to rise, 40% of Canadians currently anticipate falling home prices over the next 6 months. And then finally, they are saying that job security remains about at historic averages, with 13% of respondents saying they are at least somewhat concerned about losing their job.
And there's one other element. 47% of respondents said their finances have worsened over the past year. Yes. Their highest ever reading for this question and surveys going back to 2008. Mm-hmm. Not ever. It's a good headline, but I mean, I think it's something we do know. People are getting, inflation is eating into people's, disposable income. And I think that's the biggest thing here. On a job, like you talked about, the job basis, it's just remains,
job security.
Pessimism on jobs remains just at historical averages, right? Yeah. So we're not anywhere. And Aaron's talked about this before, particularly in the US, like the job picture there still continues to be strong. So, it's a pinch of the wallet. It's more than a pinch in some cases, but I think you're seeing more of that, and there certainly is a more pessimistic outlook out there,
for sure.
So see that translates into consumer spending, which drives North American economy. Likely have some tough comparables, going into the end of this year and the start of next year.
Yeah.
All right. Any other comments on that, or you want me to get to the star?
Let's get into the star.
You got nothing.
From our Stars and Dogs segment, it's time for this week's Star.
Star of the week, Hammond Power Solutions, Inc., symbol HPS.A on the TSX. $20.50, $241 million market cap, not a billion. We'd like it to get there, but not anytime soon. 2% dividend. The company has a history that dates back over 100 years. They enable electrification, I said it better this time, through a broad range of dry-type transformers, power quality products, and related magnetics. The company serves the oil and gas, mining, steel, wastewater treatment, commercial construction, data center, EV charging, where it is in every Tesla station across Canada, energy storage, solar, wind power generation industries, all these industries. So let's look what drove the jump in the share price. Q3 results 2022, sales increased 56% to 149 million. Earnings went to 97 cents from 34 cents in the same period last year. The order backlog increased 141%. Cash generated 16.5 million in cash from operations in the quarter. The numbers were great across the board as costs stabilized, margins recovered from the second quarter. They have historically high production volumes. That's having a positive impact on margins. They continue to experience a very favorable environment with sales across all business regions continuing to grow at the highest rate in the company's history. Given the momentum and the number of business opportunities management sees around the business, they have announced prudent spending, capital spending moving forward selectively in terms of their manufacturing capacity and service capacity. So the company has a cash position and balance sheet that have continued to strengthen over the first 9 months of this year. It's gone from a net debt position to significant net cash, provides a solid foundation to grow organically into 2023 and beyond through organic and through acquisition. Now the stock is up 67% year to date, 20% in the last 2 days. Despite this, it will likely earn north of $3 per share this year. It gives the stock a PE of well under 7. The gains this past week, however, and year to date, give Hammond Power the coveted status of our star of the week. Okay.
Very rare to find a company outside of energy with that kind of a year-to-date.
Yeah, it's true. Well, one thing that they've been able to do is they got ahead of inflation with price increases over the last year and into this year that have allowed them to, maintain margins. And I think you do have a perfect storm. Like their traditional industries, huge transformers for the mining industry, which has been doing well, the energy industry, which has recovered significantly. And then you've got them in EV charging, data centers, and solar. So all of those areas at once. Typically, it has one area doing well and another area not doing so well, and then it kind of shifts back. I think they've got a pretty perfect storm with some price increases. You can't expect that growth going forward in this business. Like that is historic growth. It's not going to happen going forward. But the share price has done tremendously well. They've upped their dividend. They probably up their dividend next year. It's just a sleepy little business that Canadians don't own. It's a company that pays you a dividend and has some growth and is trading at relatively reasonable prices. Will not be growing at 50 to 75% year over year every year, but over time, it's in some good industries and should, as we see the world continue to electrify, this company should participate as kind of a backbone to that. Mm-hmm. Now, we are going to be doing our first management interview. It is with, this week, Renee Gorham, President and CEO of TSX Venture-listed BioSyent. Again, they are a profitable, growth-oriented specialty pharma company focused on in-licensing or acquiring innovative pharmaceutical and other healthcare products, primarily for the Canadian market. Again, we got a great interview for you this week. We're going to launch into it with Renee right now.
The following is not a recommendation or endorsement and does not constitute financial advice. KeyStone and KeyStone employees hold beneficial long positions in BioSyent at the time of recording.
Well, today we are introducing a new feature to Keystone Stock Talk show, CEO interviews. We are interviewing quality businesses with solid track records of growth, solid balance sheets, and which we consider within our model of GARP, or growth at a reasonable price, with the potential to provide solid long-term returns. Now, this week, we're going to get right into it. It is my pleasure to introduce the president and CEO of BioSyent Inc., symbol RX on the TSX Venture, Renee Gorham. Hello, Renee.
Hi, Ryan.
How you doing?
I'm very well, thanks.
Good to see you.
Good to see you.
Yeah, I mean, I've talked to you many times in the past. I'm introducing you to more of our team here today, so there's a lot of heads up on the screen for everybody. But I've just gotten back from California, so I'm just getting acclimatized today. My mic wasn't working earlier, so Renee's been very patient with us. Or it was my earphones. Sorry, he's been very patient with us, which has been great. It's our first time doing these interviews, so we're going to get to some good questions. We're doing it kind of in the theme of when we do as analysts, when we talk to management teams. These are some of the questions that we'll pose to Renee today. We're going to look at it from the perspective that we are just investigating this company. We're not, but we're going to look at it from that perspective to give our listeners a good idea of what BioSyent does, what we might ask a business like this when we're doing an interview, to consider to put our money behind it and our client dollars behind it as well. So Renee, let's get you to just from your mouth tell us a brief overview of your business, and then we can drill down on some of the individual products, obviously your core brand FeraMAX, and then get into where some of your growth products and growth opportunities are.
Okay. So BioSyent is a Mississauga, Ontario-based Canadian spec pharma company. We in-license and acquire assets for commercialization in Canada. And for some of our assets that we own outright, we commercialize those through partnerships outside of Canada. So we look for these unique and differentiated products that are not available in Canada. We find them in Europe, in the United States. We have worked on opportunities with Japanese partners. And we look for products that will address an unmet need. Do something different or better than an existing product in the Canadian market. And then we provide all of the services and support for commercialization of these products that you would expect to see in the pharmaceutical industry. The difference is that we're not a research company. So the risk part that is associated with pharmaceuticals and biotech is not really part of our business model. We de-risk it by focusing on assets that have been commercialized somewhere else and have development has been completed.
Excellent. That's one thing we definitely like about the business. In biosciences, generally, you can look at companies that you have a hope and a plan at some point to bring a product online, but there's a tremendous amount of time and a tremendous amount of risk that goes from that concept to actually bringing sales in and then driving cash flow. So with BioSyent right now, we already have existing cash flow in licensing products. Their primary product is under the FeraMAX brand. Can you go into that and then talk about the launch where we expect to see more growth is from the FeraMAX PD platform? So just talk about FeraMAX. It's the #1 doctor recommended supplement in Canada, iron supplement in Canada. So can you go into that? Just describe that main product.
Yeah, so FeraMAX was launched,
or brand.
FeraMAX was launched to the Canadian market over 12 years ago. And it solves a distinct problem for oral iron supplements. Generally, iron supplements are not well tolerated by users, by patients. They cause gastrointestinal upset. So FeraMAX is a carbohydrate wrap around the iron and essentially allows the iron to be absorbed in the duodenum. And that means that most of the other products are kind of start corroding in the gut and cause constipation, upset stomach, gastric pain. And so that is really the purpose of FeraMAX. We have been promoting this now to doctors, pharmacists, nurse practitioners, and consumers for, as I say, over 12 years. We have a national sales force. We've got, I guess, Canada-wide distribution. I think there are about 11,000 pharmacies in Canada, and I would venture to say our product's available in 95% of those pharmacies, if it's not higher. The business has grown steadily for the entire period that we've been in the market. There have been periods where it's grown faster, and we have the product is contract manufactured for us, and together with our manufacturing partner, we undertook some development, just essentially to further kind of demonstrate innovation. One of the things you've got to do in pharmaceuticals is to innovate, to hold your share. It's a hyper competitive industry, and so we've been innovating so that we can hold our share and grow our share. So we introduced this polydextrose iron complex formulation. It is patented. It goes out into the mid 2030s, the patent, and this is really to differentiate ourselves to our competition. We took our existing products and reformulated them with this new compound, and started the process of switching them out of the market. So we didn't add it, we replaced existing products. That process started in about this time in 2020, and we've done it now for our 2 FeraMAX products. In 2023, we'll be launching our first new product using this compound, and it'll be innovative on a couple of fronts. I can't really speak too much about it at this point. We're not like most pharma companies that telegraph what they're up to well in advance. We find we would rather come to market without giving our competition advance notice.
So we know that the FeraMAX brand is by far the most important in terms of revenue in the business right now. Can you give us a ballpark in terms of what the percentage of revenue that comes from the FeraMAX brand?
Yeah, so that number's bounced around a little based on what the entire portfolio has looked like, but we're somewhere in the mid 70s in terms of the ratio to top line right now. It was,
that gives our listeners a really good idea of
where it was lower. At, right? It was lower, but we discontinued some products last year.
Yeah, and that it's a good core brand, and that's why you're looking for diversification for sure, right? And that's how we can get into some of the other products that you're bringing online right now. Tibella, which is a women's health product, launched in July 2022. Do you want to just tell our listeners what the product is, and then we can get into in terms of what you're looking for over peak sales, over what time, and how they're tracking today to where your expectations were when you launched?
Sure. So that Tibella was launched in July of 2020. So we're just over 2 years.
Yeah, I don't know why I said 2022. It's 2020.
Right. It's so Tibella is for vasomotor symptoms. So you hear of, there's no women on this call right now, I can see that. So for menopausal women, some of the symptoms they experience are hot flashes and night sweats. And
I have 4 sisters.
Okay,
so
well, there you go. So this generally happens just prior to menopause, and for some women can run for quite an extended period of time and make sleeping difficult and working difficult and life difficult. Tibella is a formulation of a product that was launched in Europe about 25 or 30 years ago, never brought to the Canadian market. It's an example of, I say, we look for products that are unique and differentiated and not available in Canada. When we in-license a product, we are the sole marketer and distributor of those products in Canada. We've had excellent feedback. The Society of Obstetricians and Gynecologists in Canada have just last year rewrote their guidelines that obstetrics and gynecology and family medicine follow for women, and Tibella and its common name was written into the guidelines. So we're pretty excited about that, and we've had some very positive feedback. And with a prescription medication, which this is, we don't often hear directly from patients, but I have personally received email into my inbox telling me how much of a difference our product has made to some patients.
It's got to make you feel good, knowing that you're helping people.
Excellent. Well,
yeah, it's rewarding.
Yeah. It's
we
get that kind of communication. I'm not going to say all the time, but we get it frequently enough that we recognize that what we're doing is making a difference.
That's good. Yeah, no, we ask for feedback all the time, and we only read the ones that are nice. So it's about 5%, but we still think it's great, right? So, and we're just talking on the podcast. We got a lot of client feedback that's good, which is good. No, I'm kidding. So so we write down, when we do interviews in the past, we write down things that our management team said. So I remember I interviewed you several years ago, and you talked about just a basic ballpark for where you're looking for Tibella. Peak sales, a low range would be in the range of 4 million, high range in the range of 10 million. So it may take 4 to 5 years to get to some range like that. Now, how are you tracking to those numbers today? Now, we do know there was this thing called the pandemic in the middle there this was before that these numbers were that you looked at and what we talked about. So that threw a wrench in things, and we can talk about that at some point. You haven't been able to get out in front of doctors, but how are you tracking to those numbers? Do they still sound somewhat reasonable, or are we in a range there?
So we'll talk about COVID, and it'll sound like the dog ate my homework, but it's been a challenge for our industry, for us. But I'll answer the Tibella question directly, and then we can talk about the dog eating my homework.
Yeah.
We're probably a third of the way, our run rate, our current run rate would be about a third of the way on the lower end of that range after 2 years. Yeah. And I would say I'd give us a C- performance to expectation. I would say that partly a large part of our challenge has been access to the healthcare professional through COVID, and I guess between the patient and the doctor not seeing each other in person. In this specific area, hormone replacement therapy, doctors prefer to initiate therapy when they see the patient face to face. So if the patient's not going to see her doc, or the doc is not seeing their patient in person and doing telephone consults, it's hard for them to initiate. That would explain a chunk of what I would say being behind what we would have expected by now. With respect to where do I see it, do I still see it in those ranges? I would say, as I think I may have mentioned at the time, that the 10 would have been really everything working well. And
you did.
I would
blue sky potential.
I would say that that's unlikely, but not impossible.
Good. Now, as far as I guess we can move from that product to Combogesic. Now, this is a product that is essentially acetaminophen and ibuprofen in one tablet. You can describe it even better than me, but it was launched December 16th, 2020. Do we have that one right?
Yes, we announced it in...
to the date. We don't have to the hour, but we'll try that next time, right? So it commenced first shipments to Canadian wholesalers at that time. You expected at that time, why don't you describe the product, and then we'll talk about expectations and see where we're at.
Sure. So Combogesic is a combination of acetaminophen and ibuprofen in a ratio of 3.3 to 1. And it essentially, combines these trusted, I'm not going to name the brand names, but if you were to check those out, you would recognize those brands in a heartbeat. These are large, entrenched brands that have been, well known amongst Canadians for pain relief for decades. It combines those two compounds, which most patients or consumers of analgesic medication don't even realize they can do safely. It's something that doctors, healthcare professionals, dentists have been combining for a long time. And the idea is that the combination of these two in a single fixed dose is easier to take. There's less juggling of timings on ibuprofen and acetaminophen have different dosing schedules. We find that the onset of action, so when it starts working and killing the pain, is faster with Combogesic, and it has a longer duration. The other thing that we know from talking to both pharmacists and doctors is there are a lot of people that take off-the-shelf pain medication and don't get the desired result. So they're looking for another solution, and that's the picture of our patient or our consumer. Is we're really there to solve the problem for those people that have failed on other medication.
Okay. So the total addressable market is massive, like even just in Canada, relatively speaking. But where is there a niche for you? And talk about the product. Is there protection in terms of patent protection? Where are you at on that? And just where do you think the niche will be? And then we'll talk about your expectations.
Yeah. So because you think of pain medication, you think, well, when I have a pain, I hurt my elbow playing golf, or I've got a hangover, I'm just going to go to the local pharmacy.
Brennan has one right now.
I'm going to go to the local pharmacy and I'm going to just get my pain medication. That's not our market per se. It may become that, but really our strategy is to be the preferred choice of the healthcare professional. So when you've got we find is, our research tells us this, is that when the regular one isn't working, you either go to the pharmacist at the counter and you ask, okay, listen, this is my pain, this is my situation, and so we're looking to have the pharmacist recommend, and also the doctor. About 50% of the pain walk-up consultations that a pharmacist has are with patients that have tried other pain medication and are looking for a solution. It's about the same ratio for GPs and family medicine. So,
yeah, and you have that referral with Ferromax now, right? Like the number one doctor recommended in the country. You'd love to get that with.
Oh yeah, that's and the numbers are great. Like it's a massive category, and I'm not going to give you I'm sure you've talked to people that tell you about how massive the category is, and all I have to get is 1/4 of 1%, and then like that's not our approach to the business. We're building it kind of from the healthcare professional and their patients back to a business. And of course, we've looked at what they've done in other markets, and in other markets, the product has been treated more like a direct-to-consumer product, but that's not our strategy. In terms of potential, this has been a tough journey for us. The competitors are very well entrenched, and it's been harder for us to break through. COVID has been a massive factor, but for different reasons than I explained on Tibella. But the traffic in the doctor's office has been an issue. This category, therapeutic class, is often initiated with samples. And I don't know if you gentlemen have had a chance to go by or try Combogesic. I encourage you to do so. We might make our sales tick up a little bit. That would be fantastic. The product is brilliant. It works really well. I personally use it because I'm a golfer and I've got issues with my elbow, and I need less than I would normally take if I took ibuprofen. So the product works, but you got to get the sample to try it. And this has been an issue for us. Our ability to get the sample to the patient through the doctor has just been impaired through COVID. It's been better in the last 6 months. And as a result, we've seen the business finally ticking the way we would have expected, a year ago.
Yeah, you had a significant uptick in both Tibella and Combogesic in terms of sales in the last quarter, from low numbers though, but it had a significant jump up there. Now, when we originally talked on it, you talked about the opportunity being larger than Tibella, just ballpark speaking. You expect the product to eventually challenge Ferromax. It has the potential as the largest product in terms of sales. You said peak sales will take longer than Tibella. So how is Combogesic? You talked a bit about how it's tracking today. Do you still think that that's reasonable?
I might kind of soften my enthusiasm, but that's recency bias talking. So it's not the market any different than what we believed it to be, but it's more recency bias. In other words, it's been a tough road, and it's kind of like jogging on the beach. When you thought you were going to be on firmer sand, I would say that's how it feels right now. We've got lots of encouraging data in our KPIs that the business is moving forward. I would say for sure the road will be longer, but the market is there, and the feedback we get on the product is outstanding. So it's not a product issue. It's just it's getting to both the healthcare professional and the consumer and having them come together with that kind of change in habit. And there's a lot of entrenched habit in this category that we're overcoming.
So is it more of a spend in front of these doctors and pharmacists, or is it more time that is needed, or a combination?
Not sure what you mean by spend. Spend to kind of...
Well, getting in front, like if you got to get samples in their hands, if you've got to get, is it going to keep more marketing spend on this, or is it just time and education? And it may take some money to get behind education behind the product.
Both. Yeah. We're doing things like engaging with teaching pharmacy that provide tools to pharmacists to help their patients or customers manage pain. So we're doing a number of things in that area. I would say that work will continue, and it's a long game. Like that's the one good thing here is it is a long game. And we're growing our sales force, but we're not growing it just for Combogesic. We grew our sales force last year. This year, we've got new products coming to market, so our footprint on the ground is greater. So I guess in that regard, that is a greater spend that we've got in aggregate. Then it's a question of how much time is allocated to the Combogesic interaction with customers. I guess it's a combination of the two. It's likely more investment to get to a level that we feel is a good foundation for growth into the future.
Excellent. Now, the new women's health product you talked about, which is yet to be it's not named as of yet, but cleared certain key regulatory hurdles during 2021. Launch preparations for this product are underway. Any details on the market size, potential there, peak revenues, expected dates of launch?
It's known as a syndrome, not a, what we're going after is a syndrome, very undiagnosed, large cohort of women that suffer the symptoms of the syndrome, and it impacts women differently. So the market itself is, relatively large, but because it's fairly undiagnosed, this one will be a fairly long game. We know we have a specific wedge, or we know where to go to kind of get the discussion going with doctors. There's a certain group of doctors that we're going to start with. So we think it's the revenues that you used before for Tibella, it's in that range, maybe a little bit stronger. This one is a little different in that eventually we'll be communicating directly to the patient as well as to the doctor. This will be less interaction with pharmacy and more interaction with doctor, specialist, and patient. Whereas, for example, I'm not sure if you're aware that on a product like Tibella, we cannot communicate by law directly with the patient. So, in the US, you see a lot of advertising of medication directly to the consumer in magazines and television. That's not allowed in Canada. You can't, on a prescription medication, you can't talk about brand and indication in the same advertisement.
Unique challenge for marketing, for sure, in the Canadian market now. And Renee, when Renee talks about having a product be 4 million in terms of revenue at peak, it is meaningful to this company because 28 million roughly in sales in 2021. So if you can get to that, it can really add to growth over time. So just to give the listeners an idea, that is a meaningful product in the portfolio over the long term. Now, can you touch quickly on the international business and then the legacy business, and then we can move into some other questions.
Sure. So our international business is a way to increase the sales of FeraMAX, any of the put-ups of FeraMAX. So we sell to 4 markets right now, but not necessarily all products. And we've got I'll call them partner development initiatives in a couple of additional markets. So essentially, because we own the mark, all of our other products are in-licensed and we're not the owner of the mark, but we have long-term distribution and licensing deals. In the case of FeraMAX, we own the brand. And so we have looked for opportunities to maximize sales outside of Canada. So, we've had sales internationally, I think, going back 9 years. It has ebbed and flowed, and we are, for the most part, our business is being done in not what I would describe as A or B markets. And as a result, we're kind of our partners, it's not us directly. What we do is we partner. Think of the opposite of what we're doing, where we partner with pharmaceutical companies and take on all the obligations, regulatory, Health Canada, and then getting it into the distribution channel and promotion. We rely on partners to do that. So we're not taking that risk in our business. And we've had some issues with that business, and I would say I don't see it. It's been very lumpy. We've been as much as I think $2.5 or $2.7 million in sales, and a couple of years ago we did $250,000, and I don't see that changing in the near term.
Yeah, I think what you've said typically is you'll take the incremental revenue and profits and just live with the lumpiness. So that's how investors should look at it. One quarter, it could look great. The next quarter, like the last quarter, I think you had 0 international revenues, correct? Like Q2. It can look like that, but you're not going to not take, because it is a profitable business. It can add to the cash flow. So why not do it? So that's, it's going to be lumpy, and expect that going forward. Now talk about the legacy business.
Yeah, so we started life, I guess this iteration of life, as an ag tech company. We're actually based in Vancouver. We were an ag tech company. We rebranded the business in 2006 and pivoted away from ag tech to human health. And so we sell a non-chemical grain insecticide. It's used primarily in cereal grains. Our primary market is Canada. We do have some business in the US that we have a sales agent, and then we just sell directly to regional distributors. That business is not as bankable as pharmaceuticals when you have it up and going, because it really depends on conditions. How many acres have been seeded? What have the growing conditions been like? A whole raft of factors that make it very unpredictable. But it's a nice business. It doesn't take much management time. It doesn't take very little time internally in the organization. It generates a high level of profitability. We run it. It's been running about $1 million in revenue, but it's been more in the past as well.
Yeah. Okay. Now, you just for the start of this year discontinued 3 products, 2 brands. Can you detail? I mean, we know, but can you detail for our listeners the rationale behind the transaction?
Sure. These were two products in one brand, the Agatil system, and another product known as Sysview. They were in quite different areas of business, but they relied on reimbursement, or the payer was the hospital. And I think I think people recognize that hospitals have got some serious budget pressure with evolution of demographics is one for sure that's happening right now. Provincial healthcare budgets under pressure. And so we found that challenging environment to begin with. In addition, there were things that were specific to each of those separately. What we did is we choreographed it to do it at the same time to kind of rip the Band-Aid off. And in the case of SysView, our arrangement with our partner had a requirement for us to make further milestone investments. We did not see a pathway based on how that business was going to get a return on investment. So rather than to spend more to generate a very nominal amount of, well, that brand wasn't profitable, but maybe a nominal profit in the future, we decided that we would not continue with that asset. With the Agaton system, it was really a matter of one profitable product and one product that wasn't profitable. And we just decided that we would focus on higher growth opportunities that over time could deliver a higher level of profit.
Yeah, and you can see the rationale too. When you remove those from your results in the last quarter, sales were down, but the profitability was actually up significantly. So, from a profit perspective, a good decision to exit those from our perspective. Now, let's look at the balance sheet. We love companies with great balance sheets. BioSyent, for its size, tremendously strong balance sheets. $27.8 million in cash in the bank as at June 30th. Basically no debt. Now, that would be, just to give you an idea, around $2.20 per share. The company trades just above $7 today. So it's a significant chunk of this business just in cash. And it's a profitable business. So what are your plans or uses for that cash near, midterm, and long term? You've done share buybacks. We can touch on that first. You recently announced a quarterly dividend, which is great to see. Acquisitions, we'll talk about the current environment. But let's just look at your share buybacks. I can detail them for a second,
Sure.
And you can go into them. But we've seen you reduce from, I think it's just 2018, you had 14.67 million shares out. To 2021, there was 12.6 million shares out, 14% lower. I think you spent 13 million in buybacks. So tremendous. What that does on an incremental basis, on a per share basis, if we look at this company, you earned in the last 12 months about 50 cents per share, correct? Without those buybacks, you would have had 43 cents per share. So on a per share basis, you as a shareholder have benefited significantly from those buybacks. So, you can, if those numbers are correct, I think they are from there, and it's improved even heading to this year as well. But do you have further buybacks planned? Is it going to be part of the structure going forward? We believe it is, but you would like to hear it from you.
Yes. We intend to continue to buy back shares. We don't chase the market. I think my observation, I've seen some companies use it as a tool to kind of prop up their share price. That's not our strategy. But yeah, I would say that it is our intention to continue to invest in NCIB. I'm pretty sure we're in blackout right now, so our quarter ended September 30th, and we won't be coming out with our Q3 results until November. So we're in blackout, but we provide written instructions to an agent that acts on our behalf, and I'm pretty sure they were in the market every day this week. And so, we're in the market now, and we intend to be in the future. What we found is our ability to deploy capital under NCIB has it's inconsistent. That's essentially kind of, if you phoned up and said, hey man, like the market's gone haywire, you should just grab every share you can get your hands on. It's tricky because of the rules for the TSX Venture around what we can do when we're buying back.
It is true. Now, the other side of this is too, the company's not issuing a ton of shares through a share option plan, because there's some companies that are buying back shares and issuing, and your net you either stay the same or they're issuing more shares through their share option plan. So you guys, you're not doing that. Can you talk about the way you incentivize employees?
Yeah, so we haven't
you have RSUs.
We haven't issued any stock options in 3.5 years. We've essentially put that form of compensation for managers and executives on hold, and we replaced it with a restricted share unit. And now an RSU isn't by definition non-dilutive, because if you just issue from Treasury, then it is dilutive. But what we've decided to do is capitalize on a strong balance sheet. And what we do is when we essentially, it doesn't have to be timed exactly, but what we're doing is in the open market, we're buying back shares for our RSUs. It's actually a different agent acting on our behalf than the one that we use for NCIB. And they hold those shares in trust. And as those obligations under the RSUs come due, then we already own those shares. So there is no dilution. And that's the way we've done it now for 3.5 years.
Okay. Now, recently announced quarterly dividend. Do you want to give some quick details on that and the rationale
there? Sure. We announced, we adopted a dividend policy in August. And just a few weeks ago, our board of directors announced the issuance or declaration of the company's first dividend to shareholders of record on, I think, the end of November, to be paid on December 15th. It's a 4-cent per share dividend. And we've also disclosed that it is our intention to pay that on a quarterly basis. So it's a quarterly dividend starting December. So the quarters being December, March, June, etc. That is about, based on our shares outstanding, not including what we bought yesterday in under the NCIB, is about $500,000. And our rationale was, it wasn't one reason that we decided to do this. We've got a number of shareholders that have been with the company for quite a long period of time. We have seen extreme volatility in our share price over the last several years, like extreme. Like we were through at the beginning of a COVID, you could buy us for $3.50, I think. And so we know that we're doing good things with growing our business, and that we have a very long-term view of how we're managing our business. And so we're looking to attract shareholders that are interested in that process and that journey. And we think that it's just a good way to kind of keep them involved through the payment of a dividend. But the thing that I'd like to add to that, Ryan, is that our strategy is about growing sales and diversifying our portfolio. And the first dollar that we make available is to those two things: selling more of the existing products that we have and finding more and in-licensing and launching those products. So this is not us saying, well, we can't grow anymore, let's pay a dividend. This is really, we're growing. We have a capital light business model. We have a 12.5 year, I think it's 48 consecutive quarters of profitability. And it just recognizes that our balance sheet is disproportionate to our business, and we just want to get that right sized. So those are...
No, I mean, I think it's an old thought process to think once the company pays a dividend, that then it has no more growth available to it. Some of the best stocks we've ever bought and recommended to clients are what we call dividend growth stocks. So, growing that dividend over time and rewarding shareholders with that dividend, it keeps good shareholders in the business long term, which is, a great thing to see. And you get paid to own the shares through some volatility. Now, in a best case scenario, if you can continue to grow cash flow over time, would the process be to raise the dividend over time, be a dividend growth stock at some point?
You're not going to make me promise that, are you?
No, I don't need you to promise. I said best case scenario if everything goes
every
right.
expectation. Yes. Yeah.
Yeah. Okay. Now we'll hold you to that right there. So there's acquisitions in licensing in the market. How is the current environment? Now we've talked to a number of teams in your segment. differing opinions. It was very expensive at some point, starting to see, which is across all industries really right now. You started to see things come more into a range where it's more realistic. How is that market for you? What are you seeing?
Right. So I'm going to break it into kind of two buckets. The one bucket is acquisition. And when we talk about acquisition, we're talking about acquiring assets that are already launched in market and generating revenue. We have looked at more opportunities in the last roughly 12 months than we had in the 3 or 4 years before that. I think part of it was kind of what's happening, the macroeconomic environment, interest rates, I think has been part of the story, but not all of it necessarily. So we've had plenty of deal flow. There's nothing that I would say at this stage in that regard that we're working on, but we're always on standby. And the key players in that area, they know we're interested. But we just have found, even though, some may feel prices are getting more reasonable, I think what our experience has been, if you look at the Canadian specialty pharmaceutical market in the last decade-ish, roughly, maybe 8 years, there's a long history of overpayment and capital destruction in our view. And so our approach is, I guess, a little bit more responsible, a little bit more conservative. I'm wearing a blue shirt for a reason. So that's just our approach to the business. And so we're not going to chase. We thought we were close on a couple of things, and then somebody else has decided that return on investment is, they can get it at a higher price. And so we decided to back off on that. On the other bucket is licensing. We have seen no reduction or increase in activity and competition. It's different players. It's like a game of whack-a-mole. So the players of who are available and who's in the market looking for assets to in-license has changed. Some of them are the same. Some of them have stayed the same. But what we've experienced is that companies have come and gone. Some of them have literally run two wheels into the ditch and never come out of the ditch. And so we don't see any more or less competition. The last time we did an in-licensing deal, it was that women's health product. It's been a while, right? So it's not like we're not working on it. We did get deep on several transactions, and for a variety of reasons, never the same reason, didn't get them to the finish line. Sometimes the kind of phase 3 trial results, the clinical trial results, didn't pan out, and it didn't make sense for the asset for us. That there are a number of factors, but the fact is we haven't in-licensed something now for some period of time. But it's not that we're not working on transactions, and it's not like we don't have deal flow. We've got as much in our funnel as we've had ever, I would say, and more people working on it than we've had.
Okay, let's quickly touch on during COVID, access to healthcare professionals, doctors, clinicians, pharmacies. Difficult, improving now?
Yeah, it's better now than it has been at any time since the beginning of March of 2020. Not back to normal. I'll give you an example. In Ontario, the Ministry of Health has been imploring doctors to please come and see your patients at your clinic, and that didn't really work. So then they were going to make billing changes. They said, well, you can't. We're going to make it so that you can't bill for remote consults. And they said, we're going to implement that in October. And then October came and is about to come and go. Oh, we've punted it to December. So, I don't know if it's ever going to go back to pre-COVID. I think that I don't expect it to. And so it's a challenge for us, but it's better now than it has been since COVID began. We're now probably getting to about 90% of our targeted calls on an aggregate of our whole sales force, probably about 90% of our targeted calls of what we would have expected pre-COVID.
Okay, that's good color on that. Now let's talk about the financials. 2021 was a tremendous year. 28 million in revenues, up from 22, I believe. 49 cents per share, up from 29. So tremendous growth there. The first half of this year, you have discontinued products in the Canadian pharma. If we exclude those, I think the first half revenues were up 4%, with discontinued products down 2%. When do you think you can make up for the absence of those discontinued products? How long do you think you start to lap that and have growth on a total basis? I mean, there's growth there in the Canadian pharma right now if we exclude those, which we should. But where, in terms of total growth, do you start to lap that?
So the short answer is by next year. The more detailed answer is, we have really three buckets, right? We have the legacy business you asked me about, we have the international business, and we have the Canadian pharmaceutical business. And those three together, form the top line that you talked about. And yes. So, we've got some of our legacy business. There's a little bit of bobbing and weaving there, inconsistency of what I've seen. And our international business is, as I said, is still going to be very lumpy. I would say that we will have replaced the value of the discontinued products, top line value. We will have replaced them with new products, some of which were launched before they were discontinued, just to be clear. But we also have new products coming to market, which we expect the two new products should be revenue generating by the second quarter. So I would say all in all that we fully expect to have made up for and be growing the business by the middle of next year on a run rate basis.
Now, in terms of your core product, Ferromax, in the quarter, it was down, just for Q2, down 8%. Can you go over how the wholesale trade inventory was reduced slightly in that quarter, how that affected things?
So we publish our results because they're linked to financials, and we talk about units are what we ship to wholesalers. And of course, nobody goes and buys our products from a wholesaler. They go buy them from the pharmacy. So we report sales in units, dollars in units, let's call them, and to shipments to wholesalers. The wholesalers ship to pharmacies, and so our best proxy for consumption is when it gets shipped to the pharmacy, because no pharmacy is buying it unless they've got patients or consumers buying from them. And what we saw was kind of a shift this is not new, but we've seen this from time to time where those two seem to be out of sync. I think what we saw is that the retail sales have continued, and obviously we're having a discussion now about results ended June 30th. It's late October. I can say that the trend is consumption is I'm not going to use the word strong, but stronger than what our primary sales would have indicated to June 30th.
Okay, and we did touch on Tibella and Combogesic, the growth. Tibella in the quarter was 52%, Combogesic 45%, obviously from a small base. Is that kind of the growth you expect on an annual basis, or was that tremendous growth in one quarter from a low base? Just to give us an idea.
Our experience is the year-on-year growth for launch products, as you establish a base in the first year, regardless of what time of year or what quarter you launch, and then you've got, as you kind of intuitively, you've got a higher growth rate at the beginning of the curve, and so as your denominator is lower. And so I would expect those products, Combogesic, we would expect that to continue for some period of time. Tibella, maybe not so much, because it's a little bit deeper in its evolution and penetration in the market. But yeah, I mean, I would expect strong double-digit growth for some period of time from those products.
Good. So despite this, the slight revenue drop in the quarter, profitability was up in Q2, and it marked the 48th consecutive profitable quarter. Net income after tax for Q2 increased 20%. The net income after tax margin increased to 18% from 14% in Q2 2021. Now, this was due to essentially the expenditure, or you pulled out those discontinued products. Is that the main impact on the margins there?
The margins themselves, we had some launch expenses related to.
Yeah, you would have had the launch.
Yeah, so we had some launch expenses that would be of a, more of a one-time nature, but yeah, I mean, so that the revenue is impacted by pulling out the products that we've discontinued. The profitability. Yeah. I think it's just really, there's some timings there in terms of in planned investments, when those investments are made. But yeah, I mean, as I mentioned, some of the discontinued products, 2 of them were very thin margin, gross margin, and no actual operating margin. So we've replaced them with higher margin opportunities, but we have to invest in growing those products.
Yeah, so that would be my next question. Can you expect that net income after tax, that 18%, is that a number that you'd look for going forward, or because you have an increased spend on maybe in a quarter or over the course of the next year on Tibella or Combogesic, would it eat into that net income after tax margin?
Yeah. Of course, I think of NIAT in 2 ways. One is the ratio you described, and the other one is the absolute dollars. Over time, we expect that NIAT margin ratio to go up. I would say in the next 12 to 18 months, that would not be the case. I would say we've got more investment in sales force and marketing and launch initiatives. We are investing in our FeraMAX lifecycle strategy, both on development and also some research that we're doing, not research as in R&D research, but marketing research. And all of those together aggregate a greater spend. I would expect that our OPEX next year might grow by 20%. I would also expect our revenue to be
sales.
Yeah.
Yeah.
Our sales to grow as well, obviously, but our OPEX,
that's right. Yeah. Okay. Yeah. Now, the potential for a recession, how does that affect BioSyent?
Yeah. So at BioSyent, we're in an interesting place. The what you spend is less discretionary when you're spending on your health, generally.
Yeah.
And if you go to a hospital and they need to put a catheter into your bladder and use cathegel, they're going to do that. So it doesn't matter if there's a recession.
We would hope so, right? Yeah, we would hope.
Yeah.
Do it. Yeah.
So exactly.
We know
so
they do.
Now, I think of what's going to cause the recession, which is really very much central bank driven and interest rates. And that's inflation. And so that is having an impact on our business for sure, right? Cost of goods, moving goods. We are generally an importer. I told you earlier, we look for products all around the world and we bring them to Canada. So, we got to get them here. So there's a supply chain cost. And then there's also just generally the cost of manufacturing. What we hear from our partners and across the industry is there's labor cost pressure or lack of labor availability, which drives more investment in labor. So we're affected more by inflation. Recession, I would say number 2. And yes, listen, we sell premium products. Our products are not the lowest priced. So there will be cheaper alternatives in the market. And I expect that will have an impact on us. But we're not a Ferrari dealer, right? So if I'm a Ferrari dealer, I'm really worried about it. We're not a Ferrari dealer.
Now, we like management teams that have skin in the game. Can you tell us what your shareholdings are in the business and if you're buying shares today?
I own about 17.5% of the company.
Yeah. I should say we do know this, but we like to have our listeners hear this as well.
Say it out loud.
These questions.
Look into the camera. Yeah. So I just under 18% of the company. Of course, that ratio goes up as we're buying back shares. It's not the reason that we're buying back shares. I've explained that already, but and I am participating in our employee share purchase plan, which we have. I think 80% of our employees participate in that. So I'm buying shares every 2 weeks, I guess.
Okay.
I'm not directing that because that's done by an independent party. But I'm buying back. We're buying shares. Yeah.
So what would you be most excited about right now for shareholders of BioSyent if we look 2 to 3 years going forward? And why should people buy BioSyent stock?
Well, I was going to say the thing that, there's business reasons and market reasons is the way I would describe it. I don't think people appreciate the long-term growth prospects in our business. I think they're missing that. We're doing it a little bit on the quiet. We're not a big promoter. You don't see a press release every time we kind of go to a meeting or do something. I think we've done some very interesting things that are going to build some value, some revenue and value in our business long term. I would say that they're just generally underappreciated, which is it's fine because we're not a capital consumer. We have a capital-light business model, and we're a cash-generating business. And I think the new products that we're bringing to market, some of the innovation that we're bringing that we've talked about today, I fully expect our business will be 50% larger than, let's say, last year's revenue. And I expect that to be, over a 5-year period of time. If you look at the 5 years that ended last year, and use the previous year as the base, I think the business grew 60% or so. And I would expect that we'll do that again for the next 5-year period of time. So it's not one single thing that's got me excited. It's just all of the various growth prospects. It's what we're doing isn't binary. It's not like if this thing works, it's fantastic. We've got a number of things that we're doing that we think in aggregate will layer up to building some value for shareholders.
Okay, is there anything you guys want to touch on? Oh, Aaron's muted. It's okay. It's perfect. Yeah. We usually ask at the end of these, is there anything that we didn't touch on today that we really should have?
Boy, you've been thorough.
I know. We sometimes do longer than this, and I think that either us or the management team is grabbing a sandwich or falling asleep. But you got to be thorough.
Yeah.
Right? If you're going to put money behind it, you got to do that.
Yeah. No, I understand.
So nothing really, right?
Yeah. No. We didn't dig deep into competitors and we're in a competitive business. It's a very competitive business, and we compete with small companies, tiny ones, and we compete with the biggest. And it's it's not an easy breezy business, but there are barriers to entry, and we're well past those barriers, and so we're feeling pretty good about what we've built so far. But we've got a long way to go.
I've got one question. So for the sales reps, are they given the whole portfolio of products to sell, or maybe 1 or 2 products, or how does that work essentially?
Yeah. So typically we'll build the sales force around the needs of the business, the opportunities for growth, and the call points. We call them call points. So we talked about calling on a hospital, or calling on a pharmacy, or calling on a family medicine. So it depends on which product are an appropriate fit, and then how many of those there are, and then where they are. And the other thing that we factor in is frequency. So one is, who do we have to go see and where are they? And the other one is, how often do I have to get there to deliver the message? So that's frequency. So on a product that's been launched and is well known in the market, your frequency requirement is lower than it is for launch products. So we put that together in a fairly sophisticated model that then dashboards for us. Literally at any point in time, I can tell you how many calls our people made yesterday, and how many of them were on targeted doctors and targeted pharmacies, et cetera, et cetera. That typically what you'll find is up to 3 products on any call. But we do have right now. We had a couple of reps that were kind of a contract team calling only on dentists. That's all they were doing. We don't have that team anymore. Right now, everyone else has got more or less the same type of healthcare professional they're calling on. But when we launch next year, one of the new products we mentioned, that group will be fully dedicated, but much smaller. And because the call points of where they're going to, who they have to go see, there's significantly fewer of them because it's a specialty product. Yeah.
Perfect.
Great. Well, we really appreciate your time, Renee, and going through this, being the guinea pig on our first management interview that we actually do on our podcast. I mean, we've been doing these for too long, like 20 plus years. So, but not in this format. But I'm really pleased that we got to chat with you here, and I'm sure our listeners are all going to be pleased to hear this episode. We'll get the feedback, and if they're not, well, that's they're not looking at. You need to be looking at good companies like this. It's one of the 15 to 25 stocks that if you're looking 2 to 5 years forward, which most of our listeners and clients are. It's a good quality name, and you can look at a company like this to put in your portfolio. Certainly not being paid to say that. We just look for good companies that we want to put in our portfolios. Yep. So thanks for doing the interview, Renee.
Thanks for inviting me.
Thank you.
Have
Wish
a good
you all
afternoon.
the best.
Cheers.
You bet.
Bye.
Yeah, you have a good day.
Bye-bye.
Thank you. So that was our first stab at a CEO interview. Give us your feedback. Tell us if you want those longer, shorter, whatever you liked about it, whatever you didn't like about it, Brennan's face, whatever we want to talk
Brennan's
about
questions.
in these interviews.
Yeah.
You like Brennan's face. If you've got other questions for us to ask for companies that you'd like to see us asking, put those forward. Comment on us on our YouTube. Smash the subscribe button. Continue to do that. Attend our seminars this week, Wednesday. That's the 2nd. Next Tuesday, the 8th, 7 o'clock Eastern, 7 o'clock on the 8th, 7 o'clock Pacific on the 2nd. And if you want to go to Vancouver in person, become a VIP client, or in Calgary over the weekend on is it 5th and 6th?
Correct.
Or 4th and 5th?
5th
and 6th. Thank you. By all means, sign up for those. There's only a couple seats left. As always, I'd like to wish everybody profitable investing. Thank you.
Thanks, everyone.
Thank you.